Welcome to another episode of Equity Mates, a podcast where we explore what is possible in the world of investing. If you've just joined us for the very first time, we have a massive episode for you today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. Another big one. We are back with the latest Pimp My Portfolio. We are launching a new segment called X Marks the Stock. We'll explain it when we get to it. And we're going to be covering the news that is moving markets with a particular focus today. We wanted to do a deep dive on a news story that caught our headline.
Well, with that tease, let's get into it.
News and markets.
Headlines we're going to cover today: the rise and continued rise of Chinese electric vehicles. Ren, you're going to ask me if I'm finding more robo-taxis interesting. And Elon Musk is launching a social media platform for kids.
All right, well, let's start with Chinese EVs. As I said in the intro, we wanted to do a particular deep dive on a news headline that caught our attention. And it is all about the rise and continued rise of Chinese electric vehicles, and not just in China.
Yeah.
So an association of Australian automotive dealers asked a think tank, the Centre for International Economics, to do a piece of research to forecast future demand for Australian auto sales. And here's what they found. Well, we start with a bit of history.
Yeah.
10 years ago, almost no cars sold in Australia were imported from China.
Yeah.
Today, Chinese manufactured cars make up about 17% of sales. So that's a pretty amazing step change in 10 years. But by 2035, they predict that 43% of cars sold in Australia will be imported from China.
I have noticed a huge increase in the amount of Chinese EVs I'm seeing on the road.
Yeah, particularly with Uber.
Particularly with Uber.
Yeah.
Particularly with Uber in a city. My gut feel is if we ever get to buying a car, it'll be a Chinese EV.
Yeah, well, you're not alone. BYD has already overtaken Tesla as the best-selling electric vehicle manufacturer in Australia.
More range. Not in
like
distance, but as in just a greater choice to choose from.
Yeah.
So I'm not surprised.
Yeah, the Tesla brand hit will be studied by marketing
time.
and business schools for decades to come, I think.
Yeah.
So BYD is obviously the most well-known, but I think the important thing to stress is there are so many more brands coming. Yeah. There are 23 more Chinese brands that are already for sale in Australia or have already confirmed launch plans in Australia. And on top of those 23, there's another 5 that are seen as likely to arrive soon or announce launch plans soon.
It's crazy.
There's going to be more Chinese car companies than there are online brokers in Australia. So
yeah, there's so many. And they all kind of look sort of similar-ish. But yeah, BYD, MG you would have seen on the road. I'm just looking at the list here, but there's... The Great Wall obviously is popular with the utes.
Oh, yeah. They were early.
They were very early, yeah. Anyway.
So we'll get to that because we want to talk about what's happening in China as part of this deep dive, because I think that is only the scratching the surface of this story. It's much bigger than just an Australian story. But let's just ask, why are we talking about Australia? So Australia phased out tariffs on vehicle imports in 2010.
Yep.
Whereas the US and the European Union have responded to massive Chinese investments in the electric vehicle market to support their domestic manufacturers by imposing tariffs.
Yeah.
So we're kind of seeing it before a lot of the rest of the Western world is seeing it because of different import rules. But it is a global phenomenon.
You're right, Ren. So BYD outsold Tesla in Europe for the first time in May. We spoke about that on the show. And over in China, luxury local brands are beating out the foreign brands for the first time as well. The Bentleys and co.
Well, have you heard of AITO? AITO?
No.
Okay, so this is in the luxury market. So and luxury in China is defined as cars priced over 500,000 yuan.
Okay.
So AITO is now in 2024 it was the top selling luxury car maker, 151,000 cars sold, and AITO is backed by Huawei, the phone maker. That is the best selling luxury car brand. Next is BMW, 145,000. And then if I just go down the list, Mercedes, Land Rover, Porsche, Audi, Volvo, Toyota. this Chinese domestic luxury brand is priced similarly to some of these other ones. You know, we're only looking at cars above 500,000 yuan, but it is beating them now.
Interesting. If you have a look, an Ato is kind of a mix between an Audi SUV, like a Q5 or Q3, and like a Porsche Cayenne. There you go.
There you go.
Yeah, it looks pretty good.
Electric vehicles has been a strategic priority for China.
Yeah.
And this is alongside their massive investments in renewable energy.
Yeah.
That they want to dominate the next
the next 1,000 years.
The next, but like the next economic,
Transition.
the next economic phase that we're entering, they want to dominate the energy transition.
Yeah.
But to illustrate how much of a strategic priority it has been for China, the government has provided hundreds of billions of dollars, by some estimates as much as $350 billion US, to basically kickstart the EV industry. And that $350 billion estimate is between 2009 and 2023.
And it's not just EV makers getting in on the action because of it. Consumer electronics companies are also starting to get in. So Xiaomi and Huawei, they're pushing into the market. Xiaomi's YU7 model received almost 300,000 orders in 1 hour.
Xiaomi's founder is kind of seen as like China's Steve Jobs. To the extent that Xiaomi is a smartphone maker. When he first announced his first smartphone, he wore a black skivvy, like dressed like Steve Jobs. Speaking of Steve Jobs and Apple, just as a side note to this whole conversation, the fact that Chinese smartphone makers are now having real success in the electric vehicle market and their thesis was essentially a car is now just a smartphone with wheels.
Yeah.
Like it's all just...
why can't Apple?
Well, Apple, I was having a look. According to the New York Times, they spent $10 billion
and
trying to
10
build
years.
trying to build an electric vehicle,
Sacked it.
and then they gave up on it.
Yeah, I think they sacked it last year, didn't they?
Yeah, it puts that in perspective when
Yeah.
these Chinese companies, obviously they've had a lot of government support,
Yeah.
but they actually did the thing that Apple couldn't do.
Yeah, exactly. There's a market there. They know there's a market there. The government said, let's just do this. Whereas kind of not the same here. But in fact, towards the end of it...
There was a market.
Yeah,
Like
but towards the end of the last couple of years, everyone's been like, oh, EVs kind of dying. You know, Ford was pulling out and a lot of the big old school manufacturers.
Yeah, but Tesla.
Yeah, but Tesla. It's Tesla.
I guess so. So the question then becomes like, is this just a story of like Chinese government largesse? Is this just like the Chinese government subsidizing an industry that won't be able to survive? A number of Chinese EV makers, look, to be honest, that no one's probably ever heard of. I certainly hadn't heard of. Leap Motor, Li Auto, Ceres Group. Tell me if you've heard any of these. They've all started to turn a profit.
It's crazy.
And so like these, I mean, similar to Tesla. It relied on government subsidies for years, on Californian tax credits and the like, and then it became profitable. Now a lot of these Chinese EV makers have relied on government support for years and are finally becoming profitable.
Crazy given the amount of companies there are.
Well, yeah, it's like the competition in China shouldn't be slept on. It is a red hot market there because there's so many companies competing. It's also the world's largest auto market just in terms of cars sold each year. So if you can win there, become profitable there, in theory, then you'll be in good stead to go overseas as well.
Yeah.
So that's the story. Like this Chinese EV story, we're seeing it play out in Australia. It's gone from 10 years ago to an estimated 43% by 2035. That same story is likely to play out around the world. So if you're an auto investor, if you own Tesla or any of the legacy automakers, Ford, Volvo, Volkswagen, whatever it is, this is the biggest threat to your investment thesis, I would say. And I think this and then daylight behind it. But as we went down this rabbit hole, there was some interesting stuff we found, because it's not just that the Chinese car makers are making cheaper cars. They are adding features that we haven't seen in Western cars before. So the SU7, which is by Xiaomi, it has AI features. It can help with parking. Okay, well,
That's-
Western cars are doing
that's
that.
nothing
Okay,
new.
yeah. Hey, start of the list. It can play movies for passengers. Again, like
Rolls
not.
Royce, next, done.
Oh, yeah, right. But you can also now control your Xiaomi home appliances from the road. Hey Xiaomi, get the heater going.
Not that
hey
impressive.
Xiaomi, start the coffee maker.
Not that impressive.
I think that's
you
kind of
can
cool.
do most of that with your iPhone anyway.
All right, well, if you don't think that's impressive, what about some of these? So these are videos that we'll insert, but I'll just show you from my computer. So this from Link & Co, company I've never heard of before.
This is a $45,000 Chinese Range Rover
Look
competitor.
at that. You don't have to get
Now,
in the
if I
seat.
press this button,
Well, you have to get in it.
But
Watch this.
it moves for you.
That's ridiculous. That'd be good for old people, to be honest.
Yeah, but that's not the best part.
have you ever wanted to have a meeting in a car?
No.
How about that? All the seats can turn around.
Why would you want that? You can't drive it.
No, the driver's seats are at the front.
Yeah, but it's moved down. You can't drive.
What do you mean?
Like the driver's seat's out of action.
No, it's not.
Yes, it is. Look at it.
Driver's seat there.
Yeah, but look at what happens to it. It
look
goes
up
out of
here.
action.
You
See?
get a
No, then it
30-inch
can go back
6K
once the
drop
seat's
down
in
it
place.
doesn't.
display.
It doesn't, 'cause this
Same
goes
as the
back.
30-inch
It's literally to have a
6K
meeting
blade
as the car's parked. Completely irrelevant feature.
Fair. I didn't notice that when I first watched it. Okay, all right. You
The,
don't-
the thing for me, and this goes back to why I was probably going to buy one, is as he said, like this is 45 grand.
yeah.
Like so affordable.
I reckon they would have thought about the driver's seat, putting it back in action. You probably just have to move some things around.
No. You're not driving that.
You don't reckon?
No.
Okay, let's
way.
not get bogged down on that because I've got other features to show you. Have you ever wished your car could jump?
No.
Well, here's what BYD are doing. You can jump your car. Very theatrical video. Look at that. It jumps.
That's like doing a bunny hop on a bike.
Yeah, your car's doing it.
You're so irrelevant again.
What do you mean? Imagine if there's like a lot of nails on the road and you're on need for speed and you need to jump.
This is literally for people, a getaway car.
All right, so you're not impressed by the spinning seats. You're not
The spinning seats were all right, but like functionality wise, it's not something I've been desperate for.
You're not impressed by the jumping car.
No.
Okay, this one is the Western car makers are also doing it, but I thought it was pretty cool. So Huawei have been investing heavily in your least favorite topic, autonomous vehicles.
Yeah, okay.
This video shows their autonomous vehicle. Well, they build the software, but their technology driving on a Chinese road, which I think is pretty cool. So indulge me.
Okay.
Driving on a Chinese highway, look at that traffic, and it's just navigating it seamlessly.
Yeah. I mean, it's awesome. For me though, like I don't need to now be convinced that the technology's there. That's the thing.
Self-driving
for me.
technology.
Yeah, like it's a reality. Now it's just like, let's just get this thing to mass market as fast as possible.
Self-driving technology or Chinese EVs?
Self-driving Chinese EVs.
Okay, well look, that's
Tell me when there's self-driving motorbikes.
Oh wow, that's probably a good segue to the story I wanted to bring to you, which was again I want to ask you: is this interesting? So speaking of autonomous vehicles, tell me if this story piques your interest. Uber announced that it is getting in on the robotaxi boom in a big way. It's already partnered with Waymo, and you can order Waymo self-driving cars through the Uber app where Waymo is available. But Uber has announced new plans to deploy more than 20,000 robotaxis over the next 6 years. They're buying the vehicles from Lucid Motors, the electric vehicle maker, and then they're partnering with the autonomous driving startup Neuro to power the robotaxis.
Yeah.
Interesting or not interesting?
Mildly interesting.
Okay,
The only reason I
alright,
find it interesting, to my earlier point, is this is like getting better at scale. Waymo only has at the moment like 1,500 cars on the road. This is like 20,000 cars over 6 years. It's doubling every year what Waymo currently has on the road, if that makes sense. Like it's about 3,500 cars a year, call it.
Okay.
And so I think for me, this is like getting to mass adoption earlier. Yeah, mildly interesting.
Mildly interesting. Okay.
I like the quantum of it. 20,000.
Okay.
Yeah,
All right.
but let's just get global rollout. Let's get global rollout.
All right. Well, that does it for EVs. I will continue trying to convince Bryce that robo-taxis are interesting. But let's close this news segment by asking what as we always do in our daily news email, you can sign up in the YouTube description or in the podcast show notes. But Bryce, what had us scratching our heads today?
Elon Musk's AI company, XAI, which is the parent company now of Twitter, or X as he calls it, well, as it is called, and Grok, they've announced that it will launch a kid-friendly app called Baby Grok. This is a chat bot they say will be safe, kid-friendly, and allow kids to start interacting with AI.
Yes, which has me asking two questions. One, did anyone ask for an AI chatbot for kids? And two, does anyone trust the makers of the chatbot that called itself Mecha Hitler and has gone off the rails a couple of times to create that AI chatbot for kids?
I don't love it at all, but it is the reality of where we are currently at as AI continues to penetrate daily life. That's only going to be something that parents have to deal with. Where were we talking the other day? I think we were talking among our friends. Would Simon allow his child to fall in love with a robot?
Oh, that's a whole other rabbit hole that we're not going to go down. I also just think no AI chatbot has age verification at the moment. When you're making an AI chatbot for kids, I guess it's that's the one that parents download for their kids.
Yes.
But you'd have to be a pretty brave parent to just be like, we're going all in on AI. Yeah. But you could just go to chat.openai.com and
easily.
Yeah.
Yeah.
Anyway,
Leave
it keeps going.
This is Pimp My Portfolio. Pimp My Portfolio.
We have a community member on the line who has submitted their portfolio for our expert here in the studio to review and provide some ideas on how it can be improved. Our expert today is Matt Ingram from North Haven Financial Management. Matt, how are you?
Yeah, good. Thanks, guys.
And on the phone, we have Rugved from New Zealand. Rugved, how are you?
Very good, thank you. Thanks for having me.
No, thank you. I think first New Zealander here on Pimp My Portfolio. So great that we've made it across the ditch.
No pressure.
No pressure.
It's an honour.
Before we jump into it, Rugved, can you just introduce yourself to the audience?
Yeah, sure. So my name is Rugved. I'm an accountant and I've been investing on and off since university, but probably more regularly over the last 3 to 4 years, basically. Yeah.
Love that. Well, we've got a big portfolio to get through, Renzo. Talk us through it.
So I'll start with ETFs, which are about 55% of the portfolio. We've got a number of NZX listed ETFs, the New Zealand Stock Exchange, Australia Top 200, New Zealand 50, US 500, Total World ETF, and an Emerging Markets ETF. Then we've got some US listed ETFs as well. Schwab US Dividend ETF, Vanguard S&P 500, Vanguard US Growth, and iShares India 50. We've also got some managed funds, a high growth investment fund, Foundation Series US 500, Total World Fund, US Dividend Fund, and another Total World Fund. That's about 30% of the portfolio. The remaining sort of 15% of the portfolio is direct stocks, Air New Zealand, Westpac, Wesfarmers, Berkshire Hathaway, Apple, Alphabet, Palantir, and to close it out, a little bit of Bitcoin.
What a portfolio. Some absolute bangers in there. Love to see it.
So Matt, we always start with a nickname. So what would you call this portfolio?
So I actually spent a few years in New Zealand and I got to know their lingo a little bit.
No. Yeah, okay. So what have you got?
The phrase that I heard that I quite liked there was, oh, sure, bro, that's sweet as. So that's why I've called the portfolio.
Right.
What do you think about that, Rugved?
I'm honoured by that description, to be honest. So I'll take it.
Nice. Well, why don't you take us sort of through the portfolio? How have you been thinking about it? How have you come to sort of build it as it is today?
Yeah, sure. So at the very beginning, I mean, like a lot of people at uni, I kind of picked individual stocks, which I regret now. But yeah, those are my sort of Air New Zealand, Westpac, those ones, and there were a couple of others which I've actually sold. And then as I've kind of learned more and read more, I've kind of moved more towards the ETFs, so the S&P 500s, the growth funds and things. I mean, the reason that why there's so many different funds is because I keep picking the ones with the lower fees, and that keeps changing. So like that's why it's kind of yeah. So I kind of
Fair
need to
call.
simplify that a little bit, but yeah.
And how are you investing at the moment? Is it on a consistent basis? Is it when you just have a sort of lump sum savings? How are you approaching allocating at the moment?
Yeah, the last few years it's been every month. So as soon as I get my paycheck,
Nice.
it's just invested straight into those, the US 500, the World Fund,
Yeah.
a little bit in the dividend fund I'm putting in now. But yeah, it's just split up like that. And then occasionally if I have a little bit extra, and I've done a bit of research, I'll put a little bit into individual stocks, but not so much anymore.
Love that. Love that. All right. Well, Matt, what is your initial reaction here?
Yeah, there's a pretty busy core happening here. Rugved, can you tell me a bit about these smart ETFs? I guess we don't really have them here. Yeah, I mean, is that one of the main providers there?
Yeah. So Smart Shares, they do listed on the NZX, but yeah, they are basically an index fund provider for S&P 500, for a whole lot of world funds and emerging markets and things like that. But they do track VOO for the S&P 500. For the other ones, they track the listed companies in America. It's just an NZD. So
Yeah, so I might have this wrong, but when I was trying to get my head around these, for example, like the Australian top 200 ETF, it's the fee is 0.3%, but then it basically just has like the underlying Vanguard ASX 200, which is like 0.04%. So is that what you mean by you've just been chasing the lowest fees recently, realizing that these are a bit expensive and there's cheaper options?
Yeah, that's correct. So the fees, I mean, that one particularly, the fee is pretty high, but I can't find another option for the ASX 200, to be honest. So I'm kind of,
So the brokerage you use doesn't give you access to ASX listed ETFs and stocks?
Yeah. I mean, that Smart Shares one, they didn't at that time. But now they do. So that's why there's two different funds for the ASX 200. So that one has the lower fees, not the Smart Shares one. The other one is actually lower.
Nice.
Oh, okay.
Nice.
Yeah, well, look, I guess to get a bit more specific, I mean, that explains why there's so many different ETFs in there. But to get more specific, I mean, your core is touching on everything that you need in there. You've got a bit of Australia, a bit of New Zealand, a bit of US, a bit of emerging markets, a total world. So you've got a nice, well-rounded core there. Even if it's mixed between a bunch of ETFs, it's not the end of the world. It is a bit heavy towards the US, which isn't a bad thing. But maybe think about bringing some of that home, and that includes Australia. We'll let you count that as home. So maybe bring a little bit of it out of the US, get a bit more home exposure.
Yeah.
But apart from that, I think the things that jump out here is, like I said, this overlap doesn't really matter, but some of it does, where you've just got tiny holdings in something and it's just making things probably a bit too busy. So for example, going to some of the funds that you have, like you have a hedged version and an unhedged version of the same thing. This is the all world funds that you have.
Oh, yes.
And you've got 18% in the hedged and then 2% in unhedged.
Yeah.
So it's stuff like that where you could probably just consolidate that. I mean, given that the hedged version is the bigger one.
Yeah.
Maybe just tidy things up like that. But in terms of the satellite or even the core, is there anything in particular that was bugging you or that you wanted to ask about?
I was like, when I put my portfolio through ChatGPT, they basically said the same thing as you. It said that, you're too heavily invested in the US, which was fine last year and the year before, but obviously this year it's kind of, So where would you suggest, apart from like what type of funds would you suggest?
Yeah. I don't think it's too heavy in the US, but it is definitely tilted towards the US. Maybe just topping up the Australia and New Zealand as well as that. I mean, the total world stuff has a lot of US anyway, but there's ex-US ETFs out there.
Yeah.
Things like VEU,
yes.
which give you the whole world ex-US, and they've got a bit of Australia and New Zealand, but like 1 or 2%. It's very slim. So I mean, I'm hesitant to say add another ETF into this, but focusing maybe a bit on the emerging markets and stuff like that as well might be useful just to round it out a bit.
Okay.
Matt, I'm sure you've seen portfolios like this when people come and get advice from you where they've done something like Rugved, where it's like they've got multiple instances of the same fund because there's been a change where, like lower fees. Like the classic example in Australia would have been when Vanguard's VAS and BetaShares A200 were in that fee cutting war. I'm sure people were jumping between the two. Do you suggest people consolidate to like simplify their brokerage, or are you fine with them having multiple instances of the same thing? There might be some tax implications. How do you suggest people manage a portfolio like this?
Depends how much more expensive it is. I mean, if it's actually not that much of a difference, a few basis points, just keep it. And yeah, it's a bit messy, but only add to the cheaper one, obviously, purely because of the tax implications. You think you're saving a bit in fees, and you will longer term, but if it's a few basis points, it's probably going to take a long time to make up for the tax that you just paid to do it in the first place. So yeah, it comes down to looking at tax. Also comes down to, does it bug you having several things doing the same thing in there? If not really, then it's all right, just keep it.
I'm guessing it doesn't bug you, Rugved.
To be honest, when I sent it through, it kind of did now, because I was like, oh my God, I have so many things that are the same.
Oh, well, that's good. At least you kind of recognized it.
Yeah.
It would bug me.
Let's move to this satellite. There's some big names in there. Where would you start with the satellite side of the portfolio, Matt?
A lot of them are pretty good names. Yeah, obviously with a decent size holding in Apple, you've already got quite a lot of that in your US ETFs, but that's all right if you're quite keen on Apple. That's had a bit of a tough time recently with Apple AI sort of underwhelming a little bit, and then tariff threats as well. But it's Apple. It's dominant. It'll probably find its way through this mess. So I'd hang on in there. With Air New Zealand and Westpac, I really like what you said about you just bought those at uni. I feel like those are the two things that at least 5-10 years ago, before ETFs were really big and well known, most uni students probably bought a bank and an airline. Like I have so many friends that bought Qantas and CBA. Yeah. And so that really resonated when you said that. I think Air New Zealand, you could drop that. It's such a small percentage of the portfolio. It's New Zealand's only major airline. So I think if any airline in New Zealand is going to do well, it's going to be that, but it's kind of one of the only ones. There's some smaller ones too, but I just don't see it moving that substantially. So to have 1% there, you could just take that out, have that working a lot harder somewhere else. And I would also look at, Wesfarmers has run really hard. You could probably consider that. That's such a small holding as well, just to clean things up, sell that. You've still got exposure to it in the ASX 200 ETFs, some pretty heavy exposure there. It's one of the biggest holdings in there.
Yep.
So I would probably get rid of those two. As for the other satellites, yes, there's some smaller ones and some bigger ones. Westpac is getting pretty big. That would be one that I would maybe consider trimming if you want to allocate elsewhere, just because, again, the double up with the ASX 200, Westpac's one of the biggest holdings in there. You're just getting really heavy. If you looked at it in dollar terms, you probably have a lot of dollars in Westpac across the ETFs and the direct holding. As for the other direct stocks, though, I would keep hanging there. They're all pretty good names. Is there any in particular that you are concerned about or have questions about?
Well, Air New Zealand has underperformed basically pretty much since I've bought it almost. So yeah, it's good that you kind of suggested that. Do you know what? I struggle to sell, to be honest.
Yeah, fair enough. Fair enough. It's just consider that it's for the best. If it's a small holding, it's not much. I find it's like buying shares. Most people first time buying shares, it's a little bit scary, but once you do it, you're like, oh, that was easy. Same thing with selling.
Yeah.
Sell it, get it done, put it somewhere else, forget about it. Stop watching Air New Zealand. Don't pay attention to what it's doing, because if it goes up, you're going to think you're a terrible investor. So just sell it, allocate elsewhere, move on.
Okay.
Cool.
Nice.
Love it. Well, Rugved, thank you so much for submitting your portfolio. We do really appreciate it. Plenty for you to think about there. Some good advice from Matt and plenty of opportunity to clean it up a bit. But I guess from foundationally, it's certainly all on the right track. So congratulations on that. And we do really appreciate you submitting today. We know it's not easy to put your portfolio under the microscope, so we really appreciate it.
Cool. Thanks so much, Bryce, Ren, and Matt. Thank you for all your help. Cheers.
Nice one. Thanks,
Nice
Rugved.
one. Matt, thank you as always. We really appreciate your support as well.
Yeah, thanks, guys.
And if you'd like to submit to Pimp My Portfolio, head to equitymates.com/contacts. There's a form there for you to fill out. If you'd like to speak to Matt or any of our other hand-picked advisors as well, you can head to equitymates.com/advice, and there's a form for you to fill out, and we'll connect you with the best advisor. We noticed the same companies are getting mentioned over and over and over again on Twitter or X. So in this new segment, we are going to bring them to the table and have a chat about them in this segment called X Marks the Stock. That is the innovation you can expect here at Equity Mates.
All right. Well, two stocks we're going to talk about today are Oscar Health and Duolingo, but we're not going to do it alone. We're joined by Simon in the studio. Simon, welcome.
Thank you. Great to be here.
Now, some people may recognize Simon and his dulcet English tones as the man behind Mr. Beat Up. But Simon, you're not here today to talk beaten up stocks that you think have a turnaround story. Today, we are talking buzz. This isn't a buy, hold, or sell recommendation. This is what stocks are getting people tweeting.
You love Twitter.
I am addicted. Slightly addicted to X.
Do you call it X or Twitter?
Come on, guys. It's X.
Let's
now.
go with
Let's
that.
go with
I'm
X.
going to call it Twitter.
Okay.
I'm going X.
As a former Twitter shareholder, it's still, close to my heart. But yeah, that's why we wanted to get you in for this segment, Simon, because no one has their finger on the pulse on Twitter or X more than you. The idea for this segment started because you and I both were speaking about that we saw a stock buzzing on X and it just happened to be the same stock. So why don't you introduce that first one?
Yeah, definitely. So there's one which everyone's talking about at the moment. Can't get away from it. It's a company called Oscar Health.
Okay.
All right, just to set the scene, some of the tweets you're seeing. So this one's from @the ex-capitalist. The business is exploding. It's rapidly entering new markets. Here are 10 simple reasons why Oscar is a 5x opportunity right now. Another one here from Ashton Invest. The management expects $2.25 in earnings per share by 2027. Even if they only reach $1.50, a 20x multiple gets you to $30 a stock. Trades about 14 today. That's a 2x in 2 years, and that's just a floor.
Okay, so we've established there's a bit of buzz.
Two tweets.
Two tweets.
There's hundreds.
There's thousands.
Yeah. Well, yeah, because if you're not on X, X has a, what do they call it?
FinTwit.
FinX or FinTwit,
Oh.
yeah.
What we agreed is X now.
I never agreed.
Anyway, let's understand a little bit more about what Oscar Health actually is. It's an American health insurance company founded in 2012 by Joshua Kushner, Kevin Nazemi, and Mario Schlosser.
A quick aside on Joshua Kushner. Yes, it is that Kushner family. He's Jared Kushner's brother, the president's son-in-law. But Joshua Kushner has built a seriously impressive track record himself at Thrive Capital. He started Thrive when he was 24 years old. Obviously, a bit of dad's money helps. But Joshua was an early investor in Instagram, GitHub, Spotify, Twitch, also an investor in Stripe, A24, the movie production studio, Kickstarter, Databricks, Patreon, Hims and Hers. Some of those names sound pretty familiar.
Good track record.
Yeah. So then they actually, from Thrive Capital, they then started Oscar Healthcare as their own company.
Yeah, there's a bit of buzz about them. I guess their value proposition really is to help simplify health insurance. Everyone knows what a basket case health insurance is in the US. They're looking to disrupt it, make it more transparent, easier to make claims. They're already active now in 20 states. They've got, I think, around 1.5 to 2 million members at the moment. They also give things like access to 24/7 healthcare, etc., and run some of their own healthcare centers. So they're playing in that health insurance space, which we know is ripe for change and disruption.
I think the notable thing there, you said give access to 24/7 healthcare services. It's in particular telehealth services. And I think they're either heavily discounted or free for members. And that's a really key part of their value proposition. It's make the health insurance process more transparent and navigable with their technology, and then make healthcare more accessible with telehealth. That's like the two sides of their value proposition.
Well, Simo, you said that health insurance is a basket case over in the US, and they're certainly not an industry where often you'll hear consumers with glowing reports about health insurers. Not so much the case, though, for Oscar Health. Their net promoter score is 66 versus an industry average of 12.
Yeah, so I
shocking.
mean, net promoter score is obviously just a measure of how satisfied customers are, if they're willing to recommend you to other people. So seeing, industry average is 12, people aren't happy. They've come in, they're already at 66. So the bulls are getting pretty excited about that metric.
I would have assumed with the buzz on Twitter, the share price has been a good story.
Well, it has been a good story.
Recently, it's a bit off.
Yeah, well, okay, so let's start at the start. This is
Okay.
in 2021, and it falls 93% by December 2022.
Okay.
And like, to be fair, everything fell. Like, yeah, they were unprofitable at that time, and they, like every unprofitable tech company, just got smashed in the post-COVID interest rate rise era, down 93%. But like Spotify, like Shopify, like so many of these tech companies, that was a generational buying opportunity because from there it turned around, and by June 2025, it was up almost 860%.
Where is it now, though?
Well, then in the past month, it's down 40%.
Yeah, I think if you look from IPO, it's down about 50% when you net all that out.
Yeah, that's what I'm looking at. Net all that out, it's down from IPO about 56%.
Yeah, been a bit of a ride.
So what's the buzz then?
If you look at the financials, like revenue and profit, so starting with revenue, last 4 years, 1.9 bill, 4 bill, 5.9 bill, 9.2 bill. That's, I think, about 100% CAGR they're growing revenue at. And profit, made a loss of $500 million, lost 600 million, lost 270 million, and then this year they actually made a profit of 25. So they're kind of, moving to profitability. And I guess another factor as well, their CEO, Mark Bertolini, he worked at another health insurance company before called Aetna. Their share price, he actually 7x'd it in the 8 years he was in charge between 2010 and 2018. So a big reason people are getting behind Oscar Health is also because of him and the investors that Ren mentioned earlier as well. Got a really good track record.
Okay.
So I think it's an interesting one. Obviously, we're just here to talk about buzz, but I think it is notable that all of these big healthcare stories, so Oscar Health started 2012 and has done really well in the decades since. Aetna 7x between 2010 and 2018, and then United Health Group became one of America's largest stocks in that late 2010s, early 2020s period. Do you know what happened in that time period as well? Obamacare. Health insurance markets became a lot more accessible. There was a lot more government money in the health insurance markets. All of these companies.
That's about to end.
Yeah, well, not completely, but the Big Beautiful Bill takes a lot of the tax subsidies out of the marketplace. So it's going to make insurance less accessible. It doesn't overturn things like protections for pre-existing conditions. So like you would still expect more people to have insurance than pre-Obamacare. But I think it's just a watch around. American healthcare is cooked. We know it. Insurers have done very well over the past decade because it became more accessible and there was more government money. What happens over the next decade, I think, is an open question. But Oscar Healthcare is taking market share within that market. So that's why people are getting excited by it.
Yeah.
Well, X are buzzy about it. Let's move on to the second X marks the stock. And Simo, we've got Duolingo.
I know.
Okay.
Give us the buzz.
What's the buzz?
This one's Antonio Linares. You heard this guy?
No.
Should I have
heard of him?
Random
he's got
Twitter user.
92,000 followers.
No, I have not heard of Anton.
Oh, but I will be following him after this.
So
Have you heard of him?
No, but he's quite big. So his quote, Duel today is like Amazon 20 years ago. It's positioned to take the whole 10 trillion education market, much like Amazon has taken the whole e-commerce market.
Okay,
Wow,
let's be
that's
clear.
buzz.
Let's be clear that Amazon hasn't taken the whole e-commerce market. $10 trillion
$10
education market.
trillion
So what,
education market.
Duolingo is going to upend Harvard?
Well,
According to Antonio Linares.
Get Antonio on the show.
we'll get into the thesis, but maybe we'll start by just like, what does Duolingo do? I think most people probably have heard of it, maybe even used it. It's started as a language learning app, and that's main product at the moment. So you can learn 40 plus languages on there, gamifications, you get points, streaks. It's really interactive to keep you there, sticky, really good user interface and engagement. But now they're starting to move into other educational fields. So maths, music, chess, literacy.
Yeah, chess is big.
So the thesis is they're using their user interface, their data, their kind of whole stack to now educate people on anything, and they're best placed to utilize AI to do that.
Their user base is pretty large, more than 500 million registered users, 130 million monthly active, and 46 million daily active users.
Nuts. Yeah.
Huge. Everyone trying to learn different languages and the like. It's
Or
awesome.
chess.
Or
Yeah.
chess.
And like all these apps, they've got a freemium business model where they have free users that they monetize through ads, display ads between lessons to monetize that huge user base. But then they have a subscription product, 9.8 million paid subscribers, which removes ads, gives offline access, extra features, ways to win some of the gamification stuff. But then, and this is where I think a lot of the buzz is coming from, Duolingo is seen as a potential big AI winner. They've unlocked a new subscription tier, which is like an AI-powered subscription tier. It gives you live role play with an AI chatbot. It explains answers, and you can do interactive video chats with that AI as well. And this was interesting. This last bucket of revenue I find interesting. So gamers out there would be familiar with microtransactions, where you can pay in games to unlock like a new sword or a new level or whatever it is. Duolingo have also lent into that, and they have microtransactions within their language learning app as well.
Wow.
Yeah.
Well, Simo, is the stock price mirroring the buzz that you're seeing?
Yes,
there?
it's actually been ripping. It's up 100% the last 12 months.
Jeez.
It's cooled off a bit. It's pulled back a bit from May, I think about 25-30%. But yeah, I guess one to watch out for, trades at 183 price to earnings. So there's a lot of growth and expectation built in.
I've set up a long-term breakout screener for the 500 to 5,000 and kind of just check in on it. And Duolingo's been popping up for the last few months.
Yeah. So
It's got momentum.
Well, I mean, like the momentum is backed by some pretty solid financials, which surprised me because it's a language learning app. Like you get the sense that it can't be that amazing, but revenue the last 4 years, 250 mil, 370, 530, 750 in 2024. That's more than 40% growth each year. People love recurring revenue. 83% of Duolingo's revenue from the Q4 2024s, 83% of revenue was subscription revenue.
Love that. They get you with the streaks.
Yeah.
It's the whole, you don't want to miss today because you're on a 52-day streak on learning Italian.
Exactly. Yeah. And then profit-wise, last 4 years, lost 60 mil, lost 59 mil, and then inflected to profitability.
Nice.
16 million profit, 89 million in profit. 11% profit margin in 2024. But if you look at the most recent quarter, we haven't seen Q2 results yet at time of recording. So Q1 results for this year, 35 million profit on 230 million revenue in the quarter, gives it a profit margin of 15%. So profit margin's growing. And I would just note that 230 million quarterly revenue is about the same as their annual revenue from 4 years ago.
It's these type of companies where you can start to really see, I think, impact of AI on the bottom line. Because if one of their biggest drivers is this AI subscription model where you probably don't have to have anywhere near the cost base to run that versus people actually building courses and shit. Yeah, you can start to see that story play out pretty quickly.
Yeah, so apparently when they launched their AI tier, they used AI to generate 148 new courses to populate this AI tier, and they just did it like bang.
Yeah, I think that's where the bull case comes from, because it's like they've got the user experience. They know how to get people hooked. They know how to get people interested in learning. If they've got AI powering it and you can learn anything, why are you not going to use them? Like, they've got the best platform. So going back to old mate at the start, Antonio, that's his kind of whole theory, is they're going to just capture everyone who wants to learn.
Yeah.
So interesting one to watch. Next earnings on August the 6th, so keep an eye on that one.
Keep an eye on.
Now, obviously, this isn't a buy or sell, and like both of them arguably are quite expensive based on some financial valuation metrics. But quick fire around, which one are you choosing, Oscar Health or Duolingo? Simo, start with you.
I like Oscar. I just think the potential upside, if they can nail it, and the CEO's track record, I'm gonna go with Oscar.
What about you, Bryce?
I'm going Duolingo.
Same.
Yeah.
I'm going Duolingo. Why are you going Duolingo?
I just think there's, to your point around industry disruption in the States, I'm not sure how that's going to play out, but I think the AI story here, if they can expand their addressable market to the 10 trillion that Antonio Linares reckons, I think they will probably grow into their multiple, or they have the opportunity to grow into that a bit more.
Yeah. For me, Oscar Healthcare is an American play, whereas Duolingo has the opportunity to be global.
Yeah, good point. Maybe I have to do both.
Do both. That's it. Love it. Well, that's our new segment of X Marks the Stock. If you're also a big X user and you've found some stocks buzzing in your ecosystem, please send them through so we can talk about them on the show. Head to equitymates.com/contact. Simo, good to have you. You will be back as always. Probably a Mr. Beat Up coming soon.
Yes.
And Ren,
Got one
always
cooking.
good to be with you chatting stocks. We'll pick it up next week.
Sounds good.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.